What's up, everybody? Gen X Dividend Investor here. So lately I've been thinking that some of the oldest dividend companies out there, including many I own in my portfolio like Procter & Gamble, Colgate-Palmolive, and Kimberly-Clark, may not be as safe as they used to be. My main concern is that the data shows that classic household products are facing increasing pressures from generic brands sold by Amazon, Costco, Walmart, and others. Combine that with the fact that younger shoppers aren't anywhere as brand loyal as us Gen Xers or Boomers are. I mean, we grew up watching the same few TV channels and were influenced by all the same advertisements that got blasted our way. So our households used one of a handful of toothpaste brands or paper towels or whatever. But research shows that millennials and younger shoppers are more likely to buy generic store brands compared to Boomers or Gen X. Plus, younger folks are shaped more by social media than the old school TV ads that I grew up with. They also have less disposable income, and a 2025 study shows that they're less brand loyal as well. Which is why, if the big household names I invest in fail to connect with younger consumers, those companies' long-term success will be at risk. So even though younger consumers were exposed to brand names growing up, when they go out on their own, they're often going with generic options. And lots of data backs that up. Like this article found that 44% of Gen Zers and 39% of younger millennial shoppers led the way in trying store-brand generic products for the first time, followed by only 27% of Gen Xers and 16% for seniors. So younger consumers are definitely going more generic, but even some older consumers are letting go of their old brands. And almost 100% of all US households purchased at least one private label item in the past year. Private generic brand sales rose about 4% to a record $271 billion last year, and since 2021, unit sales of national premium brands have dropped by nearly 7%. Plus, surveys point out their growing trend for consumers to increase their purchasing of private label products at the food market beyond the household product market. Like some 55% of grocery shoppers bought more generic brand goods in the past year, compared to 28% who did so with name brands, per a June report from the Food Industry Association. So as investors, we need to be aware and watch the data, but also not overreact. And companies themselves are worried because they know that if they don't capture younger customers early, it gets harder as those customers age, and with trends already showing less adoption among younger people, that becomes even more concerning. And that makes sense when you think about it. I mean, once a shopper gets comfortable with something like Amazon basic paper towels, what incentive do they have to pay more for Bounty from Procter & Gamble? And then to add even more risk, big retailers can use their massive data analytics to push their own generic brands harder. Like Amazon, Walmart, and Target gather endless insights on their shoppers. They know what people are buying, what they're skipping, and what they're buying again. They know which ads actually drive sales, what price point works best, and even the ideal moment to suggest another product. They can slice all of that by age group, income, location, or whatever, and then use it to decide which generic brands to highlight for revenue, customer growth, or retention. Like Amazon might not have its own toothpaste brand, but it knows exactly what millions of their customers are buying. That lets them find similar quality products, scale them up, and sell them cheaper. They can even undercut competitors on purpose to squeeze them out and then raise prices later. Older school companies like Colgate or Procter & Gamble just don't have those same advantages. And no one goes to pg.com to buy their products. No, we either go to Amazon or somewhere online to buy it, or we go to a local physical store near us and buy it from there. Now, a fair question to ask is, in this new age of endless choices, why do so many of us older shoppers still stick with the pricier brand names? Well, one big reason is that when we were growing up, there simply weren't as many options. We were all shaped by the same TV commercials, the same jingles, and the same ads in magazines and newspapers. I mean, almost everyone in my generation and older knows the same product jingles by heart, and that plays a big role in our buying choices, even if we don't realize it. In fact, let's all take a fun little test to see what I mean, though feel free to use the timestamps on screen if you want to jump ahead. Okay, I'll tell you 7 different household product jingles that I heard growing up, and give yourself a point for each one you recognize. I want to see if the older viewers out there know these a lot better than younger viewers. The first jingle is, "As clean as a whistle." If you know what product that's for, then give yourself a point and keep a running total in your head. So that comes from an Irish Spring soap commercial, and I actually have some Irish Spring in my bathroom cabinets, and it's from a dividend payer I own in Colgate-Palmolive. Check it out.
Fresh and clean as a whistle. That's Irish Spring. Fresh and clean as a whistle.
Colgate-Palmolive has paid a dividend for the last 130 years, i.e. since 1895, and they've paid a bigger dividend for the last 62 consecutive years, making them a dividend king. Okay, the number 2 jingle is the Quicker Picker Upper. If you know what product that goes to, then give yourself a point. It's Bounty paper towels from another classic dividend company I own in Procter & Gamble.
Quick! The Quicker Picker Upper. Bounty picks up messes quicker, and each sheet is 2 times more absorbent.
Procter & Gamble has been paying a dividend for 135 consecutive years since its incorporation in 1890, and has also increased its dividend for consecutive 68 years, establishing its status as a dividend king. Or how about jingle number 3, strong enough for a man, but made for a woman? Give yourself a point if you knew it's for secret deodorant, and Procter & Gamble owns that one as well.
Great.
Great for me.
pH Balance Secret, strong enough for a man, but made for a woman.
Moving on to jingle number 4, and we have plop plop fizz fizz, oh what a relief it is. Did you get a point for that one? It's Alka-Seltzer, which we have in our cabinets, but I don't own any Bayer stock, which is the dividend-paying company that owns it. Unfortunately, they did a big dividend cut not too long ago, due to all the challenges they were facing.
Alka-Seltzer, plop, plop, fizz, fizz. Oh, what a relief it is.
Moving on, we come to jingle number 5, Snap, Crackle, Pop. Give yourself a point if you recognize the classic Rice Krispies cereal jingle.
Yes, come along, gentlemen.
Snap, crackle, pop, Rice Krispies.
Rice Krispies ownership is actually split. Ferrero holds the rights to Rice Krispies in North America, while Kellanova, formerly part of Kellogg's and still a classic dividend payer, manages the brand in the rest of the world. Kellanova has paid a dividend without interruption since 1925. Moving on, we come to jingle number 6, which is, sometimes you feel like a nut, sometimes you don't. Give yourself a point if you knew that it was for Almond Joy and Mounds candy bars, owned by classic dividend company Hershey's.
Sometimes you feel like a nut.
Sometimes you don't. Enjoy that nut.
Mounds don't.
And finally, the last jingle I'll call out is one that says, ring around the collar. It's for Whisk laundry detergent.
Dyes and powders aren't good enough. Whisk does a better job.
And when Whisk gets out ring around the collar,
Your whole wash is clean.
Whisk is actually no longer manufactured, though it was owned by a well-known dividend company in Unilever at one point in time. Okay, now leave me a comment and tell me how many of those 7 jingles you knew, and if you could name which product they came from. I myself got 6 out of 7, as I knew the ring around the collar jingle, but I couldn't remember that it came from Whisk. Oh, and also tell me what generation you're from, as I want to see if the older generations get higher scores. Now, there are plenty of other classic household jingles that older folks know, but most of them actually mention the product name, so I left those out. Like Please Don't Squeeze the Charmin, or Calgon Take Me Away, or The Best Part of Waking Up is Folgers in Your Cup, or a bunch of others. And again, why am I sharing those product jingles? Well, multiple studies have found that product jingles help with brand and product recall and retention, and that people tend to choose products tied to a familiar tune, especially if they like the tune. And a recent study showed that advertisements paired with happy music led to higher purchase intention compared to sad music, even when recall was better for sad music in some cases. And speaking just for myself, I know that ads do indeed sometimes influence me to purchase. Like the Irish Spring sport commercials got me to buy their soap over the years, and I've always been into sports and working out, and being squeaky clean is appealing to me. Plus my wife has some Irish ancestry, and I've always been fond of Ireland and its people. Anyway, the fact is companies spend billions on advertising because it works, and the main reason you're watching YouTube for free is because of those annoying ads. Those of us who are older grew up being flooded with the same product commercials for decades simply because we had far fewer shows and content to choose from. And because choices were limited, audiences were much more captive, so the same ads ran repeatedly, embedding themselves into people's memories. I mean, when I was growing up, everyone watched the same 3 or 4 TV channels because that's pretty much all that existed. But these days, younger folks have a massive amount of digital entertainment options to choose from. So instead of everyone watching the same show at the same time, audiences are now scattered across countless platforms, which then makes it more challenging for company advertisements to hit as many consumers as they used to. This fragmentation makes it much harder for advertisers to guarantee mass reach with a single ad buy, to use their terminology. Or to say that more simply, back then one commercial could reach nearly everyone, but today ads are spread thin because people's attention is divided across so many different places. However, one thing advertisers can do more easily today is to show specific ads to people that they believe will have the highest likelihood to buy. Like I'll get video gaming ads that I'll actually watch because I love computer games. Someone else who's Googling for new car prices will get car ads shown to them. Of course, most of us try to skip the vast majority of ads that we're exposed to, especially when we don't care about them. Like I'm not really interested in watching tampon ads, though the way YouTube keeps showing them to me, maybe they know something I don't. Anyway, these days many consumer staples household companies are using some of their advertising budget to go towards social media influencers in hopes of capturing the younger consumer. I know I get pitched stuff all the time to use in my videos, and I've turned almost all of them down unless I really use it and value it. Like here's one I got where they want me to pitch a Japanese skincare brand known for its botanical care and refined living. Or here's one I got about them wanting me to review their home theater recliner. The important takeaway is that younger generations don't value household brands as much as older generations do, which could make it harder for premium brand name products and companies to thrive in the future. And if they don't flourish, then their financials won't look as compelling, and all that could lead to dividend issues. But I feel like we're still in early innings, so I'm not knee-jerk selling, but I am going to watch things a lot closer. One thing I always recommend with investing is to regularly check the financial trends of the companies you own. Like, here are some of PG's financials in Fast Graphs, which I'm an affiliate of because I like it and use it, and so far PG is holding up fine. Its revenue trends look good, its growth income trends look good, its costs are under control, etc. I also recommend checking into a company's debt trends and cash flow trends and how well their divvy is covered and all that normal jazz, but hopefully you get what I'm going for. That being said, we investors ultimately should care more about how our companies will do in the future than how they've done in the past. So my plan is to keep on holding, though I encourage everyone to do what makes sense to them. Of course, sometimes the best time to jump ship is before everyone else does, though I'm sitting tight myself as I'm not seeing enough reasons to sell. But let's look at some good reasons someone might choose to sell, and then I'll go over some bad reasons. So a good reason can be if a company is way overpriced, and you want to get out. Like if a stock is trading at a historically extreme price to earnings and is well above its growth prospects and such, then it can make more sense to consider locking in gains. Or it can make sense to sell if your company is struggling to pay its divvy and that's something you want. I mean, consumer staples are often prized for their reliable dividends. But if payout ratios rise unsustainably, or if debt levels surge too much, or if cash flow weakens too much, then that could justify selling it. Ultimately, if company fundamentals deteriorate, then that's a big reason to sell. Perhaps revenue numbers are dropping due to generic brand pressures, more loss of pricing power, more shrinking market share or whatever, and if you believe it'll continue, then selling starts to make more sense. Or maybe you just see better opportunities elsewhere. Perhaps you want to sell and move into higher quality dividend growers, or undervalued companies, or sectors with stronger long-term growth prospects, or whatever, and maybe you're holding your tickers in a retirement account so you're not worried about tax implications. Maybe you're selling to rebalance your portfolio because your consumer staples have grown more than you're comfortable, so you're trimming to maintain diversification and balance your risk a bit. Or heck, selling due to tax reasons or estate planning or whatever can all make sense. But there are some not so good reasons to sell. For example, if there's short-term market noise and that freaks you out, then it's probably not prudent to sell. Or maybe you freak out and sell because the stock price falls, but you don't dig into why it's falling, whether it makes sense to unload it. Another probable bad reason to sell is if you're blindly copying someone out there, whether that's me or your Aunt Sally or whomever. It's great to understand why people invest in a certain way, but just don't blindly copy them. And speaking of blindly, another reason that might be bad is if you're chasing higher yields blindly. I mean, dumping a decent dividend payer to buy a riskier stock with a higher yield can end badly if the higher yield is unsustainable. Or it might be bad to sell if you just feel your ticker is too boring or if you're impatient. The key thing to remember is that stock prices tend to gravitate towards earnings, so if your company is performing, then the stock price should probably perform as well. Another bad reason to sell is if you overreact to headlines. Like if you're freaked out about inflation or currency swings or temporary manufacturing cost increases, then I recommend taking a breath and reflecting on if your freakout is justified. Another reason that is often bad to sell is if you're panicking in a bear market. Staples are often among the best performers in recessions, so selling during market downturns for fear, rather than fundamentals, defeats part of their purpose in a defensive portfolio. So TLDR, good reasons to sell are usually grounded in valuation, fundamentals, or portfolio strategy. Bad reasons are usually emotion-driven, short-term focused, or reactionary. Moving on, now let's focus on the bigger picture. So beyond brand erosion, there are real competitive pressures that could justify selling or trimming consumer staples dividend stocks. I mean, more shoppers are prioritizing price over brand, especially in today's lower growth wage environments. This is real competitive pressure that wasn't as strong historically. And with wage growth lagging inflation in some markets, more households trade down to generics, which can undermine the pricing power that staples companies historically relied on for slow, steady dividend growth. Couple that with the reality that retailers like Amazon and Costco wield far greater negotiating power with suppliers than grocery chains did in the past. The big boys can push their generic brands aggressively and squeeze premium branded suppliers' margins even more. So if you see those various forces as permanent structural headwinds to long-term growth and dividend sustainability, then yes, selling or at least trimming positions could be justified as a fundamentally driven reason. But let's be real, some brands still hold strong pricing power and have loyal customers. Think of Tide detergent or Pampers diapers. The truth is consumers often stick with them despite cheaper alternatives because of perceived quality, habit, or convenience. Plus, companies like Procter & Gamble and others like it aren't just US-centric. And emerging markets often still place high value on trusted brands, so established premium brands expand into those regions. Good consumer staples companies adapt to their headwinds by innovating new products, including health-conscious variants and new categories like eco-friendly cleaning stuff, organic toothpaste, etc. Those innovations can offset the generics. And finally, and somewhat ironically, during recessions, most premium consumer staple brands actually perform well. Apparently, even if some shoppers switch to generics, overall demand can remain strong because people can't stop buying essentials such as soap, detergent, or cereal. So what can happen is that premium brands often hold steady or even grow as households cut back on larger purchases such as vacations or dining out. In some cases, they even benefit because consumers treat themselves with small comforts at home, like choosing a nicer coffee brand, premium ice cream, or a trusted cleaning product, while still feeling like they're saving compared to bigger luxuries. But some companies are more insulated from all this than others. Like, think about Coca-Cola. Its brand power is still unmatched, and it's got an insane global distribution moat. In many countries, there isn't even a generic equivalent option. Plus, Coca-Cola has expanded into water, teas, energy drinks, zero sugar things, etc., adapting better than most to the evolving consumer landscape. So Coke has been able to raise prices without losing volume, which is a classic true moat sign. Bottom line, I feel that holding some consumer staples household stocks and food and beverage stocks in your portfolio makes sense, but that's just my risk tolerance. I recognize that staples are no longer the bond-like proxy and bulletproof sector that I feel they once were, but I'll still stick with my current divvy tickers for now and see how things shape up in the future. And that reminds me of a question I get from time to time, which is why I focus so much on dividend stocks. And the reason is simple. They've been the best way I know to retire with passive income, and they're also the easiest path I've seen to building generational wealth. Beyond that, I see articles like this one every day, which just came across my feed. It's about a study that surveyed 20,000 retirees and found that more and more of them are worried about outliving their savings. And because of that, many are spending only about 2.1% of their portfolios per year, much less than the standard 4% rule recommends. Basically, some people are seeing the likelihood of living longer becoming more realistic, while at the same time they're seeing the cost of housing, healthcare, food, etc. going up too quickly. So instead of living a good retired life, they're instead spending far below their means and desires. But in my experience, dividend investing retirees are living with more disposable cash from their 4 to 5% sustainable portfolios, along with maintaining or even increasing the amount of assets they own. Like, they get their divvy payouts and then reinvest a small percentage of them, meaning with each payout they tend to own a larger percentage of their company, as well as they're having cash flow to live on. And I agree that life expectancy is going to skyrocket in the years to come, so I really don't want to be selling my cash flowing assets if at all possible. For example, my wife recently shared a clip of a scientist that explained that when mankind were cavemen, 50% of everyone born was dead before they hit the age of 30. Specifically, I'm talking about people born from 300,000 years ago until about 10,000 BC. And then from then until the mid-1800s, that number only went up to age 35, i.e. half of everyone born in the 1800s was dead by 35. That means in thousands of years we only improved our average longevity by 5 measly years. And that was when no man-made pollution existed, no plastics were in your food, and everything you ate was organic. The water was clear and everything was free range. But in the last 185 years, we massively increased longevity to the point where, as of 2025, around 50% of people born today will still be alive at 73 years old, globally speaking. And in wealthier nations, that 50% survival mark is closer to 80 years old. The dramatic leap in human survival and longevity did not happen because nature was pristine. It happened because of modern science, public health measures, clean water systems, and medicine. That's why even with today's pollution, plastics, and processed food, people live decades longer on average than our cave-dwelling ancestors or even our great-grandparents in the 19th century. And now many experts believe we're approaching another wave of longevity breakthroughs, driven by AI and biotechnology. The phrase experts say is "don't die now," meaning that if you can stay alive through the next few years of progress, new therapies such as cell clearance, genetic reprogramming, and AI-driven drug discovery could arrive quickly enough to extend life massively. So your goal now should be to live long enough to benefit from the cascade of advances that are probably coming. That's actually one reason why I like to invest in healthcare companies over the long run, even if some of the largest firms face setbacks from litigation or other challenges. I know that a significant share of additional years of life have come from healthcare and pharmaceutical innovation, especially in cardiovascular care, infectious disease, diabetes, and cancer treatment. And that's also why I feel it's more important than ever to be investing in companies that can keep paying you a share of their profits rather than you selling your assets in retirement. So invest your way to success. I know you can do it. And that reminds me of a comment I just saw about a guy who dropped out of high school after sustaining a football injury and becoming depressed. but he found a job as a janitor and then managed to get a job where he was cleaning. He saved and invested, and bottom line, he said life was good, and he said he's not the sharpest tool in the shed and that if he can do it, then so can you. This guy managed to build a multi-million-dollar net worth over his life. The important takeaway is that if you can live below your means and then invest in decent assets over a long period of time, I'm sure your retirement will be great. So invest, and then do me a favor and hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Speaking of support, I'd like to take a moment to recognize my newest Patreon aristocrat, MTRun1. Oh, and I won't be putting out a video next week as I'll be out of town. Now I'd like to show my gratitude to subscribers who've left me kind comments, so I'm going to shout out 10 who've done just that. So thank yous go out to Mr. Grumpy 9914, David Bond 9783, Jeffrey W 4867, My Walking Blog, Kay Gostman, Stockjock 1222, Timeless Wealth Mentor, Pain Train X, and then multiple from Zachary Phelan, and multiple from Brian is Awesome or Awesome. Thanks folks, I really appreciate it. And with that, I'll close things off and recommend you check out my Seeking Alpha affiliate link, which often has a discount when new users sign up. I'll also pitch my FastGraphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment, even if they sign up for a full year. Also check out my Patreon page, and or consider joining my channel membership, as both have some cool perks you might like. Finally, I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 Dividend investors on it from 86 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.